This video shows a single corporate headquarters splitting its operations into two separate semi-autonomous divisions. To produce a final product, these divisions must trade with one another. Physical goods move down the conveyor belt in one direction, while internal corporate currency flows back. The management accounting system used to assign a monetary value to that internal exchange of goods, services, or intellectual property is called transfer pricing. This diagram illustrates the four primary utilities of a transfer pricing system. The top two quadrants represent performance evaluation and employee engagement. When divisions are held accountable for their own profits, the internal price directly dictates their financial results, which in turn drives managerial compensation and motivates staff. The bottom two quadrants highlight resource allocation and taxation. The internal price guides critical optimization choices, like whether a division should make a component in-house or buy it externally. For multinational companies, these prices also determine how profits are remitted across borders, directly impacting the organization's overall tax burden. The standard for achieving fair value in these transactions is the arm's length principle. This rule dictates that the price set for an interdivisional transfer must be competent and fair, exactly as if the divisions were entirely independent companies dealing with a third-party vendor. Setting that price is a complex strategic decision. A poorly calculated transfer price distorts internal cost structures, penalizes efficient employees, and leads to suboptimal decisions that damage the parent organization's bottom line. This illustration introduces our case study, TechCorp. On the left is Division A, which manufactures microchips. On the right is Division B, which assembles smartphones. Both managers have strict profit targets they must hit to earn their bonuses. If Division A transfers chips to Division B using the market price method, the internal price exactly matches what external buyers pay. This approach is unbiased, objective, and forces the supplying division to remain cost competitive with outside vendors. However, the market price method fails entirely if the intermediate product is highly customized and lacks an active comparable external market. When external markets don't exist, companies turn to cost-price methods. The first is variable cost, where the transfer price equals the marginal cost to produce one additional unit. This supplies Division B with incredibly cheap inputs, but prevents Division A from charging any markup to recover its fixed overhead costs. By denying the supplying division any profit margin, the variable cost method centralizes profit evaluation at the entity level. The supplying manager is left with no incentive to adopt cost-efficient manufacturing methods, destroying their motivation. Companies might instead use standard cost, basing the price on predetermined budgets and capacity assumptions. Because these budgets rely on historical records, the supplying division again lacks any motivation to innovate or reduce costs below the budgeted baseline. To restore the supplier's motivation, a company can use full cost plus markup, which covers all production costs and adds a guaranteed profit margin. But this creates a new mathematical flaw. Division B is forced to absorb internal selling and administrative expenses that Division A never actually incurred, distorting TechCorp's overall cost structure. Alternatively, managers can use negotiated pricing, arriving at a mutually agreeable rate. This preserves autonomy, but it requires total transparency and the sharing of internal cost data between both divisions to function effectively. Every basic pricing method creates an imbalance. Maximizing the supplier's profit artificially inflates the purchaser's costs, while minimizing the purchaser's costs strips the supplier of their profit margin. This video captures the interpersonal gridlock inherent in transfer pricing. Division A demands a high profit margin to hit its targets, while Division B demands the lowest possible cost to protect its own margins. This diagram shows dual pricing, an accounting workaround designed to end the gridlock. The supplying division records the transfer at the high market price, securing its revenue. Simultaneously, the purchasing division records the exact same transaction at marginal cost, keeping its expenses low. While this resolves the immediate interpersonal conflict, it complicates the corporate records by generating artificial internal profits. Because the ledgers don't balance, these numbers are strictly quarantined for internal performance evaluations and cannot be used in official financial reporting. A more grounded alternative is two-part pricing. In this system, the transfer price is calculated as the marginal cost of production plus a fixed lump sum charge. The lump sum charge guarantees the recovery of a specific portion of the supplying division's fixed costs. This ensures the supplier remains profitable while allowing the purchasing division to buy additional units at a rate significantly lower than the external market. These methods act as accounting band-aids. They soothe bruised egos and improve interdepartmental cooperation, but they lack the strict mathematical boundaries required to guarantee that divisional decisions align with the ultimate financial interests of the parent company. This slider graphic defines goal congruence. To align divisional autonomy with overall corporate profitability, every internal transaction must fall within a strict mathematical boundary called the zone of agreement, defined by a specific floor and ceiling. The first step is calculating the ceiling, which dictates the absolute maximum price the purchasing division can pay. The maximum transfer price is determined by taking the lower of two numbers, the external buy-in price from an outside vendor or the division's own net marginal revenue. Net marginal revenue is calculated by taking the final selling price of the completed product and subtracting the purchasing division's own internal marginal costs. This establishes a strict break-even point. Paying a single cent above this number means the division loses money on every unit assembled. The second step establishes the floor, representing the absolute minimum price the supplying division can accept without destroying its own profitability. The minimum transfer price formula is the additional outlay cost per unit, which includes marginal cost and incidental storage or transport fees, plus the opportunity cost per unit. The opportunity cost is the single variable that dictates the supplier's floor, and it is entirely dependent on the supplying division's current production capacity. If the supplying division has excess capacity, its machines are sitting idle. Fulfilling an internal order doesn't require turning away external paying customers. Therefore, the opportunity cost is zero, and the minimum transfer price is simply the marginal cost of production. If the supplying division is operating at full capacity, producing chips for the internal division means canceling an order from an external buyer. In this scenario, the minimum transfer price must include the lost contribution margin from that external sale to compensate the supplier for the sacrificed revenue. Establishing these exact limits strips emotion from the negotiation. By adhering to capacity-based formulas, executive management ensures that self-interested divisional managers cannot inadvertently cannibalize the parent company's total profits. This map places our TechCorp divisions on a global scale. The manufacturing unit, Division A, operates in a high-tax jurisdiction. The retail unit, Division B, operates in a low-tax jurisdiction. Multinational companies utilize transfer pricing to systematically shift profits across borders and reduce their total global tax burden. By setting a deliberately low internal transfer price, TechCorp artificially depresses the earnings recorded in the high-tax country. Simultaneously, Division B receives cheap input materials, which inflates its profit margins in the low-tax country, effectively moving the parent company's taxable income into the more favorable bracket. This strategy also manages currency risk through specific denomination. If management expects a currency to lose value, they can denominate the transfer price in that weak currency for the high-tax division. This ensures the resulting exchange rate loss occurs where it is most beneficial, reducing taxable income in the high-tax country, while parking gains in lower-tax regions. On an international scale, transfer pricing transcends internal performance metrics. It operates as a primary structural mechanism for minimizing global tax liabilities and protecting corporate cash flows against volatile exchange rates. Transfer pricing is the vital nervous system of a decentralized organization. It requires a precise balance of managerial autonomy, mathematical goal congruence, and global tax optimization. On screen is the accounting fix for fixed cost recovery. Two-part pricing equals marginal cost plus a lump sum charge. The break-even limit for buyers, net marginal revenue, equals the final selling price per unit minus the purchasing division's marginal cost per unit. The absolute purchasing ceiling, maximum transfer price, is the lower of net marginal revenue, or the external buy-in price. The foundational supplier floor, minimum transfer price, equals additional outlay cost per unit plus opportunity cost per unit. And the capacity rules. With excess capacity, the floor is just marginal cost. At full capacity, you must add the lost opportunity cost. These capacity-based formulas transform abstract accounting into a functional map for corporate strategy, ensuring that divisional autonomy serves the organization's global financial health.